Jim wanted to know about the market sentiment tool here on Power Options. He says, I've seen that the market sentiment tool has been neutral for some time. Should this mean that I should be entering into iron condors, iron butterflies, or things of that nature? And I'm going to say not really. We're seeing a neutral indicator. What the market sentiment tool is a collection of 13 indicators, 13 market indicators, and based on past history, so I'm just going to put up the put-call volume ratio across the entire market, the total number of puts, the total number of calls as far as trading volume goes. And this little plot here is showing us sort of the histogram of the occurrences of the put-call volume ratio, I think over the last about 7 years or so, maybe even more. Let's take a look here. How far do we go back? I'm going to go to the versus SPX. Yeah, so it goes back about 8 years to 2008. Now, what we're seeing here is that the current put-call volume ratio, today's put-call volume ratio, was at 0.69. And we can see here that 2.2% of the time, over the last, of course, 8 years, we've hit that number. Now, as we go up here, we see that, once we get to levels at around a put-call volume ratio of 1.09 or, 1.2, for example, then we very infrequently tend to go higher. Okay, so what we've done is we set indicators, or sort of fences, for each of these 13 broad-based indicators. So right now, if the indicator moves above 0.99, there's a very low frequency of it going further, so that would actually be a bullish sentiment, meaning it would start to reverse, it would start to pull back into the normal plots once it reached 0.99 or 1.0 or so. And the bearish ratio is hit in a little bit. So if this dropped down in the next couple days, our put-call volume ratio drops down to, let's say, 0.58 or so, we would see that this would trigger into the bearish range. Right now, 2 of the indicators are bearish. The VIX is bearish. As you see here, we're currently at a VIX level of 1343. It's a listing for the VIX, the volatility index, and it's typically bearish when it's below 15. Now, we do see it go to 12 sometimes, but in general, we rarely see it drop below that. And of course, it goes bullish when it goes above 25, because very infrequently when the VIX goes up to 25 do we see it continue up into those levels as well. Another bearish indicator right now is the number of days the SPX has been above its 100-day moving average. Right? So a lot of the details here are based on things tracking the SPX, but also tracking the market as a whole. Stocks hitting new 52-week highs and lows, RSI of the SPX, for example, and MACD gap also, and the percentage of stocks that are over the 100-day moving average, which is also getting close to a bearish range based on the fences that we've tested over the last 9 years or so. So, 8 years, sorry. So, does this mean that over the next 10, 12, 20, 30 days that the market's going to stay in a neutral pattern? It could, but if, let's say, the new stock 52-week high and low moves up a little bit to bearish, the VIX stays bearish, and in addition to that, the number of percentage of stocks goes into the bearish line here as well, well, that would trigger a sell warning, where we'd expect to see a pullback, because typically when we see 4 bearish indicators, we'll expect to see a 2 to 3 downturn, 2 to 3 day, I should say, downturn or so. How Ernie and I really use this is we know that we can take a look at the overall sentiment. We see here that even in the past 30 days or so, we've been in a neutral condition. Okay, so I'm going to go back here to April 26, 2016. Let's look at the history there. And see, even back into 326, we were still kind of in a neutral mode, a neutral market there. Let's go back one more month, just real quick. Okay, so the last sell warning we had was back on 317 and 318. And we see here that it got into that 2050 for the SPX, and then it started to pull back down to 2037 and continue down a little bit from there. So that's when we were seeing the sell warning. It was building up, building up, building up. It hit the levels of 2049 and 2051. That's not why the indicators were hit. But we see that that first one, can't open that up anymore, I apologize. The bearish indicator, we had 4 bearish indicators and 9 neutral, and that triggered the sell warning, and it stayed for 2 days. And right after the 3rd day is when we started to see it pull back down in price. So with that being said, what Ernie and I typically use this for is when we see a sell warning come up. If we've had stocks that have been on a good run or have been moving up in price, we may consider selling a call against it, whether it's in a married put or just a standard stock position, because the idea if it goes bearish is then we'll sell the call and then it'll start to decline. When we see a bullish signal, okay, or a strong buy or a bullish warning or a buy warning, for example, that might be when we would look to close some of our short calls on our stock positions, maybe adjust bear call credit spreads or bearish positions so that we can leave more room in the upside as well. William says, since 3/21/2016, has there been a buy signal? No, let me go back here to April 1st, historically. I don't know when the last buy signal was. I thought it might have been shortly after this, but the buy signal didn't trigger. We didn't get a number of bullish ones here. Let's change the date to where I can go to. Let's see here. Let me go to April 7th, for example, and go forward. Let's see here. Yeah, we had a couple ones on about 323 or so that where bullish indicators started to come up, and the market did move up, but it didn't sustain itself very well. So we haven't had a buy signal since then. I don't think we had one. I'm almost positive we didn't have one at the beginning of May. Let's see here. Yeah, let's go to May 2nd and go forward if possible. Yeah, I don't see anything there, and there's actually no bullish indicators were hit. And let's see, May again. I'm going to go towards, let's just go to current. There we go. Okay, now I'll go to the sentiment history. And let's see, let's go back. Yeah, right around this time, 513 and 516, there's a little indication, but again, it didn't sustain. It started to move back up and then pull back. So it had a couple of bullish indicators, but it never triggered up to more than 2 or 3 at the same time. So it didn't look like it was going to be sustained. And there were times, of course, we can see 20-point movements here in the SPX around the time you get one bullish indicator, for example. But it didn't look like it was going to sustain. It was still bouncing around as well, even though it has been bullish recently. I'm expecting to see this to go to a sell warning. I'm expecting the market to pull back in the next couple of days because the SPX has been up about 2 to 3 days in a row, almost 4. So we'll do that as well. William says, would the last buy signal have been in February 2016? I believe so. After that large decline we saw from January to February, starting on January, I think it was 5th, when things started to decline. Let me do something very quick here for you guys. Let's do it this way. Yeah, give me 1 second, folks. And what I'm going to do is actually take a look at something else. We're going to show William here when that last buy signal was. Let's see. I apologize. I'm just doing this on a different browser here. What we're looking at here, by the way, is a trial account, essentially, a webinar trial account. What I'm doing in the other browser here is that I'm logging on to my PowerOptions account rather than logging off and logging back on. Let's go into the indicator details. See, the trial account only allows us a month or so of backtesting data. But let's see here. Let's go to February. Now let's go to March 1st. There's a sell warning there on March 1st, actually. But let's go back. There it was. There was the buys around 2.9, 2.8 when it was around 1853 or so. That's when the buys triggered in February, and of course went up to 19, 1929, and we just saw we were in the 2040 range. So those were the last buy signals, I believe, around February. Well, the first ones, I'm sorry, started on February 2nd, and it was not sustained at the time, but then, of course, February 8th, 5 days in a row. And you see there we're at 1864, and, of course, we know we're at around the 2040s, 2060s right now, kind of range. We've seen that in the last month. So that would have been February 12th was the last buy signal. February 8th through February 12th were the last buy signals. And that's actually where I entered a couple of married put positions and 1 or 2 long calls there as well. Okay, so that's when that last one was there, William. All right, so let me close this now. Let's just move that away. We'll go back to our regular one here. Okay, so that's what I'm trying to impress upon you. Does this mean it's going to stay in a neutral position, that I could expect 10 to 15 days of neutral since we've seen it for so long? I'm expecting it actually to maybe go bearish in a little bit. And I'll make adjustments. I'll see a sell warning, I think, in the next 5 days or so. And I'll probably make adjustments to my position based on the fact that I think the market's going to fall for a 3 to 4 day period after I see the sell warning, maybe even an extended period, depending on how many days in a row we see the sell warning. One comment I'll take a look at here in the portfolios if I have it in here. That's the Foot Locker position. Let me see if I have it in here. Okay, let's see, where is, oh, there's Texas Instruments, good. All right, so this is no longer an April 60 put, it's actually a July put, so let me make that change real quick. I'm in a July 15 put. Just want to show this very quickly. I don't think the risk is going to be the same. I think it was 385. Let me just take a look here at this Texas Instruments. We'll go to the profit and loss chart, the custom spread tool. That's not quite accurate. Let me put this up to, there we go. That's a little bit more accurate. Okay, that's sort of where I am in this position. It's a bulletproof trade I've put out to July. When the market did start moving up the past 5 days or so, and Texas Instruments had been around 57 or so, I did sell the June 10 60 call for about 58 cents. So I had a bulletproof position. The stock was below it. I hadn't seen it go above 60. So I had a married put in place. I sold a nearer term June 60 strike call when the stock was around 59.15 or something. In the next few days, it continued to move up. Today it closed at 61.02. Now I'm not too worried about it. Normally when this stock hits $60.50 in this collar, or maybe about 50 cents or 60 cents right about the premium I received. So when it hit $60.58, I would normally look to have rolled it up and maybe out another week or out another 2 weeks to the 61 strike. I didn't in this case because, as I mentioned, the SPX and other indexes have been up for about 3 to 4 days straight, and usually that's when you expect to see a pullback based on the market indicator. And it hasn't switched to a sell warning yet, but I'm taking a chance here, and this is out to June 10th, remember, so we still got about 12 days, 14 days left in the trade, on the short call, excuse me. So I'm holding on to it even though it's deep in the money now and it's gaining in value. It's about $1.44 to buy back today, because I think there's going to be a pullback, and I expect this Texas Instruments to maybe drop down below $59 or $60, definitely 60, maybe below $59.50, maybe $59 per share. And then I'll potentially look to buy back that call rather than paying $1.40 today, hoping to maybe only paying 20 or 30 cents, and then maybe rolling it out further to a higher strike to give myself some more breathing room. Okay, so that's typically how Ernie and I use the market sentiment indicator. One more follow-up on this, and we have some other questions. William says, thanks for the explanation. Would it be fair to say that the market is neutral based on your system more often than not? Yes, and it's more, I would say, based on the ranges of what's neutral. When we were going back through, William, and we were looking at some of those numbers there for the market sentiment tool, let me just go back to the home page. And you saw at times when, just in the past month where we were going from, the SPX showing when it was still remaining at neutral. Let's pull that back up again. All right, so we've been neutral this entire time. And, here we were at 2091 on April 26th. That was the SPX price. And it dropped down to about 2050 once. That's a 40-point move. And then we go back up to 2084. And then we drop back down to 2046. And then we go up to 2052. And now we're back to 2090. Okay, so we did see recently almost a 50-point movement, 40-point movement, 42-point movement in the SPX in the past 5 days. So we say, oh, well, that was bullish, and your system missed it. Well, it was, but it's a small percentage movement on the grand scheme of things. It was a quick move. There were 3 bullish days in a row. We can see that, 2076, 2090, 2090 again, a little bit lower, dropped a little bit, but it's still holding up there. But in general, it does stay in more of a neutral condition. And that's simply because it's, this is, I don't want to say it, this is a small percentage move. Even though it's a 50, 40-point move, it is a small percentage move. Sure, if we bought weekly options on the SPX that expired this week, if we bought them on Monday when the SPX itself is around 2048, we probably had a really strong profit in 5-day trades. But it wasn't a sustained bullish indicator, and as I mentioned, expecting it to pull back. We'll see. I might not be right, but usually when you see the SPX up 2 or 3, 4 days in a row, even if it's small percentages, 0.4 for example, we still usually expect a correction. Who knows what could happen over the weekend, okay? All right, so let's see. Okay, new question coming in from Timothy. This is related to the radioactive trades and the married puts that I kind of just showed, but I converted to a collar. And the radioactive trading concept is what we approve, the approach we approve of for doing married puts and protective strategies, something I trade with about 50 to 60% of my personal capital. Ernie invests a lot of his portfolio into this technique as well. So in general, what we do with a radioactive trade, I'll just pull up Cambridge Display Technology, OLED here. Right now we could buy Cambridge at about $68 per share, $67.78, and we look to go at least 5 months out in time and keep our risk, under about 9%. That's why we're going in the money, is to get the single percent risks. So a typical position, this is higher than the risk I'd want to go, but here I'm buying stock at $67.78. At the same time, I'm going to buy the June in the money, about 2 strikes above, 75 put for $14. Now, most of that $14 is intrinsic value, right? I'm looking at almost $7, $7.23 here of intrinsic value. I'm guaranteed to get that back when I buy the 75 put. So my true risk is just the time value, which is 678 or 8.3%. So, of course, the blueprint teaches the different income methods, the different management techniques we use on this protected position. Timothy's question related to this strategy is, can you sell your shares at the married put price before expiration, even if the market price is lower than the put price? So let's say 40 days from now, even 50 days from now, I still have a put that expires in January. All right, still going to be 200 some odd days, or close to 290 days out in time. So let's say 50 days from now, on or around July, let's say 10th or so, let's say the stock is still trading at $67.78, hasn't moved much. Can I get out of this position at any time? Yes. Okay. Normally what you do, Timothy, says, can you sell your shares at the married put price before expiration? You could contact your broker. They may not have this selection on the web page, on their interface, but you can contact your broker and tell them that you'd like to exercise your put. You can exercise your put at any time. By exercising the put, that means you're forcing the put seller to buy your shares of stock at 75. You're forcing them to buy your shares of stock here at $75. So you'd get out with an 8.3% loss. However, that is not typically the best approach. There are adjustments you can use if the stock has fallen. Okay, so if the stock stayed neutral from when you got into the position, or if it fell, the blueprint teaches their income methods to use if the market is falling, your stock is falling, I should say, or if it's stagnating, if it's not moving. Okay, but all that being said, let's go to the portfolios here. And let's see. Here's an example. I'm going to take BAX, Baxter International. Let's look at that profit and loss chart again for this position. First, sorry, I opened this position on, oh, this is not a good example, but okay. I was hoping to find something neutral, and that's about the best one. Okay, I'm going to use PayPal instead. I apologize, folks. PayPal. This was done during a webinar. We simulated getting into PayPal on February 19th, buying shares of stock at $35.76. At the same time, we bought a 2017 January 40 strike put for $7. We've been in the trade for 98 days, and it's only moved up from $35.76 to $38.09. It's been bouncing around more, but that's the keys. Okay, let's take a look at our position on the profit and loss chart very quickly. All right, so I opened this position 90 days ago. This is not my real position, by the way. This is just a webinar position. Again, bought 100 shares of stock at $35.76, purchased the January 40 put for $7, total invested out of pocket is $42.76. So my maximum risk is $276. Now I still have 200 days or so to go on this put. I still have 200 days of insurance remaining. But rather than, if I decided that I don't think PayPal is going to move, I'd like to take my capital out of this position and look for something that's showing more movement. This one's really not working out well for me. I don't want to exercise the put right now at 40. Okay, I don't want to do that. I don't want to contact my broker and say, hey, exercise my put at 40 so I can close out of this position and I'll take the full loss of $276. Why? because right now, with still having about 200 days, 230 days left in the put option, the stock, remember, is at 38.09. So my 40 put is $1.91 in the money. I can sell to close the put for 460 roughly with the time spread. Okay, so it's a bid of 450 and ask of 470. I'd put in an order right now to sell to close my put at 460. Then I would go ahead and sell to close my stock at 38.09. This would give me $42.69. Okay, so we sell to close our put midpoint at 460 because it still has time remaining. It still has time value and intrinsic value. We sell to close the stock at 38.09. And we get, 42.69 back for liquidating the position, Timothy, sorry. And so now, remember, I invested 42.76. So even though I've been in the position for 90 days, the stock has moved up a little bit. I am only losing 7 cents. I am nowhere near this maximum loss of $276 or $2.76 per share. If we were 20 days away, 30 days away from expiration, maybe I'd want to exercise it if I didn't think I'd get fair value for selling to close the put. If there wasn't a lot of time value remaining, maybe I would do that. But if you have more than 60 days remaining on the put, you could evaluate other income methods first to adjust the position if you think it's going to recover, or it's always better to simply liquidate the position rather than exercising it if you still have time value remaining. Because think of, again, just we can see how the review is here. If I exercise this put today, I take the loss. I sell the stock at 40, I lose the 276 or 6.5%. If I pay one extra commission to sell to close the stock and sell to close the put, I'm only losing 7 cents per share and then add commissions on top of it, but it's nowhere near the maximum loss. All right, so that's what you want to look for. Okay, 1 second, folks. Let's take a look here. It's sorry, Mike's question. When a collar is underwater, how aggressive do you recommend being about rolling up the call to keep it OTM and down to maximize theta income? Let's see if we can go back to that position. As you can tell, Mike, I'm not overly aggressive. Otherwise, I would have rolled that other position. Do I still have it here? Yes, we do. All right. So despite the fact that this is a bulletproof position, and this is a collar here, it's a dynamic collar using the far out in time put and the near term call. This one happens to be bulletproof, of course, and a profit here about 3%, 4% or so. In most situations, and I'll show you a most situation in a minute, Mike, but in most situations, as soon as the stock goes above the short call strike price, usually by about 20 to 30 to 40 cents, that's when I look to roll the call. So in normal situations, I would have rolled this call as soon as Texas Instruments, I think it was on Wednesday, got to about $60.25 or $60.30. That's when I would have looked to make the adjustment. And I would have likely rolled to the 61 call. And now that it's 2 cents in the money, I'd been okay. Why didn't I? Is because I didn't want to add more money into this position. I'm still comfortable with this profit level. Now see, if this was a different type of collar and I had a smaller window of profitability, and with the stock being at 61, I was giving up too much of, 227 here for a max profit versus 194, and at 65, of course, we're down to 104. So that's about half, but right here is still acceptable to me. Okay, this little range here, that's still acceptable to me. And of course, it's because I'm expecting it to pull back in price. I don't want to overtrade. That's the one thing I never want to do, and I try to limit myself. Some of you are subscribed to Fusion. Some of you go through periods, maybe some of you, one or two of you online right now, excuse me, have been Fusion subscribers at Radioactive Trading for over 6 months, maybe almost a year. And I know that some of you have been frustrated, if you were following my portfolio, from probably end of December 22nd, right before Christmas, through February 10th. Because there weren't a lot of adjustments made. In fact, I don't think there were any. And the reason why is because the market was falling. I hindsight's 20/20. If I expected that amount of decline, I would have used a different income method. I would have used income method number 12 on all of my married put positions. And around what we just saw when we were looking at it with William, when I saw those light buys, I would have sold to close the extra put on that position and then let them ramp back up. And I probably would have been bulletproof on every married put trade I had. The decline outpaced my expectations and term. All right, the amount and percentage of the decline that hit my stocks from January to February and the time that it was going down exceeded my expectations for that movement. Okay, so I was caught not unawares, but after the first 14 days, said, oh, I don't think it's going to go down any further, and then it did for another 7 to 8 days. I said, well, I don't know if it can go down any further, and it did for another 2 days. Well, then it started to come back up, and we adjusted appropriately. So in this case, now that it's underwater, it's above my short call strike price, I am taking a chance here, and I understand that. The chance is this is a put option or a call option that expires on the 10th of June, okay? I am taking a chance that I could be assigned at any time and be out of the position. But I'm still comfortable if that happens. If I find out Monday that I was assigned at the 60 strike, I would just sell to close the put, and I'd have close to this 3.8% gain, probably about 3.4% gain, and I'd be very comfortable with that. Okay? That's sort of my target price. That's why I sold the call to begin with. I'm expecting, again, the market to pull back, and I'm going to look to buy this cheaper. Monday or Tuesday, excuse me, it might move up again. You never know. It could go as high as 61.80. I'm still going to hold off until a little bit to see what happens then. Okay. Okay. Let me sidestep 2 new things here. Andy. I'm sorry, not Anthony. Andy asked a question. He says, about the collar, with the profit so near the max, why not close the position at close to max profit? We're here, not quite here. Okay. June 6th. This is the halfway point. Today's liquidation value of the position, remember I'm expecting a 3.8% return. Oh, I got to add it into this. Give me 1 second here. Let's add an option leg to our existing married put. I need to simulate selling the call. June 10th, 60 strike for about 58 cents. That's the reason right there, honestly, Andy. I don't want to give the market maker the benefit of paying double right now in the extended time value on the position. Okay, so let's go ahead and submit that so it shows up as a collar in my portfolio. And to make it easier, I'm just going to go to the position analysis screen. So anytime you're tracking a position here in the Power Options portfolio, we can go to the position analysis screen, all right? And this gives me a breakdown of my current position. Now I was expecting, this is a little bit different. I think I put in the wrong number, I'm sorry. But see here, I've only got about 10 to 12 days left to expiration. And if I liquidate right now, I'd make about a 4% yield. I think I put in the wrong number, so it's showing a wrong percentage there. The 236, the 4% yield. But if I wait to expiration, the max profit's 4.5. So 10 days for a 0.5%. It's close. I'm at 89.7% of the expected profit. My actual numbers on the married put aren't that close. This is a sample trade that's really close to what I have, Andy, but it's not exact. The actual trade I have, oh, why not? Let's just take a look at it. Sorry, folks. Let's go back to my account here. Let's go to the portfolio. Here are my radioactive trades. Juniper is a position I'm tracking, but these are the ones I'm actually in for Fusion subscribers. These are my real trades in my Fidelity account as well. The Texas Instrument was sold for 50 cents. The put was at 385, and my cost basis is about 55.99. So it's a little bit different. And let's go to the position analysis screen here. All right. Okay, so it's still close. It's about 0.4%. And it's just because my sentiment is that it's going to pull back, Andy, so I don't want to pay the extra money into the position to roll the call. I will say that if the stock stays above 61, even if it goes to 61.50, but stays above 61 by Wednesday, I'm going to roll this call. Or maybe liquidate the position. You're right, Andy, I might do that. But since the put is out to July and it is bulletproof, I'm figuring more that it's better to just milk it for all it can. So if it stays at 61.50 on Wednesday, I'm probably going to roll my 60 up to the 62 for probably June 17th or June 24th on the weeklies. Add another 14 or 10 days. 10 or 14 days, I should say, and get some more premium. Just keep milking this position because I can't lose in either direction. And honestly, my target is closer to that 3.5%, and I think I'm going to be able to do that with 3 more write cycles to the July expiration using the weekly series. Okay, so that's why I haven't liquidated it yet. Usually I will when I get close to about 85% or not. Okay. All right, so let's see here. Going back to Mike's question here. Okay, now let's talk about a different collar. So how aggressive am I? As a general rule, I let the collar, and even if it's a standard collar that I also trade with about 10 to 15% of my account, just your standard hit or miss trade collar where I sell an at-the-money call and buy an out-of-the-money put with the same expiration. If the stock falls a lot while I'm in the trade, I may just get out of it because it's obviously not doing what I want. Or I may just buy to close the call, sell the stock and leave the long put open if my expectation is going to continue down. If I'm in that standard collar position, same expiration, remember, and the stock is just hovering between the two strike prices, I might hold it to expiration and then re-bracket that collar later on. And the standard collar, where I'm using the same expiration that we just saw, not this one, this is a dynamic collar inside a radioactive trade. But when I use a standard collar and the stock goes up, I typically don't roll the call up looking for more profit because I treat my standard collars as a hit or miss trade. I'm either going to let it alone and have it be assigned and make the max profit I expected, or if it falls, just let it exercise the put and get out of it for a small loss of maybe 3.5%, maybe 4% on the standard collar. And if it's in between, I'll look to re-bracket the collar for the next month. I don't stay in those positions for long term. They're usually 20-day trades, 15 to 20-day trades. As some people do with covered calls or cash secured naked puts, I just do them with collars because I don't like taking the risk of a covered call or a naked put anymore. Okay, I haven't done that in probably about 7-8 years. Okay, now, but going back to this strategy, and let me go back here. I'm sorry, let me go back into our other portfolio here. Okay. Now, Baxter International is up 10%. We got in at 39.29. It's up at 43.31. Let's say a beginning of the month, May 1st, for example. I don't even know where Baxter was, but let's say I went ahead and I had sold the June 3rd 42.5 call. Nah, let's use a deeper one. It does offer single strike, 50-cent strikes actually. Ugh, that's always confusing. I'll just keep it nice and simple with the 40 call. And at the time, let's say I got in at 75 cents. Why not? Okay. So now my call for this collar is deep in the money as well. I'm going to take a look there. And I didn't have much return to begin with. So if this was a profit and loss chart for Baxter I was looking at originally, I know I didn't have a lot of potential profit. I only put in 75 cents or so for the call premium, and it has a low risk of 3.9%. But in this scenario, as soon as the stock probably got up to 40.25, I would have bought to close the 40 and gone up to the 42.5. And by the time the stock got probably to 42.75, 42.80, I would have bought to close the 42.5 and maybe rolled to the 43 or the 43.50, maybe the 44. Okay, so because that profit, this isn't the same risk reward we saw in the Texas Instruments trade. I have to be more careful with this. I probably wouldn't have sold this call to begin with because that premium was so low based on my initial cost basis into the entire position. So there I'd be more aggressive. Let's go back here and let's look at, why not? Take a look at Kroger. This is a position I'm in, I think with the same number. Now my numbers are, I think, are a little bit lower than that. Maybe not too much lower though. I think my risk is 7.8% on the Kroger, not 8.9. But this stock has been falling. Okay, it's let's show you the chart here. I got in, I believe, in the beginning of 2016, and yeah, right around it here. It hasn't done much. Came back up here, and then it's just kind of petered out. So let's say in April, when it was around 39, 39.50, let's say that we had sold the June 40, it would have been the 40 call because we would have had more time premium in it. Okay. Let me clean some of this up so I'm not confusing. There we go. No, it's Baxter. It's PayPal. That's and that. Okay, so let's go back to Kroger. Now let's say back a while ago we had sold the June 40 call, which is only at 10 cents now, but let's say when it was up near 40, back about a month and a half ago, we might have gotten $1.50 for it. Okay, now this would have probably been a losing trade based on the profit and loss chart, but I knew that I'm planning to, oh no, would have had a profit, okay? So now here's your second example, okay? So when the collar is underwater, meaning the stock is above the strike price and I start losing the upside, how aggressive do you recommend about rolling up the call to keep it out of the money and maximize the theta income? And I've already shown that, depending on the profit and loss chart and the position as a whole is going to help me dictate. And if I have that small window of profitability that we kind of see with Kroger here too, in this instance, and for example, if the stock had moved up above $41 per share, I probably would have looked to roll the 40 call at that time. All right, so once it starts to get above the break-even line, yes, this is the halfway point. This is the blue line's expiration. The red's the halfway point. So once it starts getting above here, where I might start losing money if I held it to expiration, that might be my trigger point to roll the position. But again, usually was if I received $1.50 for the 40 call, that's why I'd let it go up to maybe 41 or so. Okay. On the downside, would I feel pressure to buy to close this 40 call now for 10 cents? Well, not pressure, but whenever I do a spread or anything like that, as Andy pointed out earlier, when I reach about 75, usually about 80% or so of the profit I expected to make in a position, that's when I'd look to close the position. Okay. I do have that, as Andy noted, on the Texas Instruments position, but my goals by July is to be closer to a 3.5% gain as opposed to a 2.3, 2.4% gain. So I'm going to try 2 more right cycles using the weekly options to get up to that 3%, 3.5% range of profit on Texas Instruments. Knock on wood, of course. Now, if I buy it back now, am I going to feel a lot of pressure to, let's say, roll down to the June 35 or the June 37.5 if it exists? No, because that could really be a bad position. Let's take a look. I'm going to go to June. We're going to buy to close the 40, okay, for 10 cents. So we keep 40 cents, or $1.40 of our premium. And this would be the same approach with a covered call. You just wouldn't have the put in place. Now, I agree. Selling the June 37.5 call at 35 cents probably doesn't match what we need. So rather than do that, I'm going to drop my cost basis here down to $35.99 on the stock. Why? Because I'm accounting for the $1.40 profit we would have made on this call. That would be my new married put with a risk of 5.9%. Now let's go out to July. That 37.5 call, not a great premium. 55 cents at midpoint, but let's use that. Okay, so remember, after we had closed this call in Kroger. If we sold that June call far out, about a month and a half ago for $1.40, now the stock's trading at $35.99, you say, oh, I got to generate more premium. Let me buy this back for 10 cents, keep 80 to 90% of what I had, and now let me roll out a month to this lower strike, this 37.5, to get some more premium. Our risk was 5.9%. Now it's 10.6%. How? How did we increase our risk by collecting more premium? We didn't increase our risk to the downside. I increased my risk to the upside because I sold a call with a 37.5 strike, and my cost basis, even after that extra 55 cents and the $1.40 we realized, is still $41.94. So if the stock gaps back up before July and it goes to, say, 42 or 43 or so, okay, then what I'm looking at is a larger loss to the upside, because as the stock moves back up, my put loses in price, my call increases, or we should say caps the gain right at $37.50, and I get no more benefit of owning the stock because of that obligation. So now I have to pay more money to roll this call up to here, to the back to the 40 strike, and it might not be profitable. So in the radioactive trades, when I have a call sold and create a collar, if it goes below, I'm okay. I don't typically over panic and think I have to buy it back and roll it down to a lower strike, because remember, it's a position as a whole. I never want to sell a call below the put strike price, especially if I fear it could recover, because that's going to put me in a worse position in the direction I thought the stock was going to go initially. Okay, now let's say that Kroger had done the opposite for us. I'm running through a lot of scenarios here, but let's say we did have the 40 put, but the stock had moved up to about 43. And we had sold, let's say, the 42.50 and the 45 call, and now the stock was trading down at 37.50. In that scenario, so our stock is at 37.50, we would have sold, let's say, the 42.5 call and still had the 40 put, so we'd have more of a position that would look something like this. Now, with the stock trading here at 37.50, I may look to buy the 42.5 back and still sell the 40 because I'm keeping it in line. I'm keeping it equal to or above the put strike price. It might generate a little bit more credit, but what you're going to see is that your peak of your max profit is going to lower. Why? Because you're only going to get 40 back now instead of 42.5. So you'll have a similar risk-reward profile. It's just going to have a lower top, a lower max profit, and you may lower the maximum risk. You probably lower the maximum risk in that scenario to the downside as well. But in general, don't feel panicked to sell the call below the put strike price if it starts to fall against you, because that could put you in a worse scenario. It's okay to let it go a little bit in the money, for example, and then roll the short call. Usually, though, what you want to make sure you're doing, Mike, is taking account of it as a position as a whole. Okay, so again, as we saw with the Texas Instruments trade, I gave my explanation as to why I'm still holding it. With the other trade in Baxter, if I had sold that call for that 75 cents or it was, there was such a tight window of profitability that I probably would have rolled it as soon as it went above that 40 strike to 42, 43 as well. Okay. All right. Now let's see. Got some other questions here. Here's one that came in. How does this response relate to covered put or naked put? Very similar in the sense that, as I mentioned, I don't do covered calls. If you're in a covered call trade, there's a couple ways you could, of course, we're just going to look at a basic profit and loss chart here. There's 2 to 3 types of covered call traders. There's many types of covered call traders, but the real approach is, one approach, excuse me, folks, is I may have an investor who's opening 10 to 15 covered call trades each month, or when they just start out with their cycle, they open about 10 or 15 covered call trades. Their hope is that they're going to get assigned as they're expecting, earn that 1 to maybe 2.5% yield for a 30-day or 25-day trade. They get assigned, they're out of the position, they're going to open a new position for the next month. If the stock falls that they're in, let's say you have 10 positions, 8 of them get assigned, and let's say on average they make the 2% yield they were hoping for. Okay, so 8 of them get assigned. 1 of them stays right at the call strike price and it expires, so essentially at break even. So then you'll probably just sell to open that call. And then the other call fell about 8%, and so you're going to look to manage that position. You're probably going to be in this one for about 4 to 5 months to manage the stock that dropped 8% to get back to break even at best case scenario. Okay, so that's one portfolio. They're just hoping to get assigned. If they get assigned, they don't worry about rolling it up and getting an extra profit, because their target was to make that 1.5 to 2.5% for a 20 to 30-day trade. They're going to take it and then open 10 new positions the next month. They may open the new a similar stock. They may roll if they really like that stock and stay in it, but in general, they're just looking to get assigned and earn the return. Many of us are different. Okay, many of you online are probably different, where you have a collection or core holdings of stock in your account, and you're selling at or just out of the money options on a regular basis, maybe monthly, maybe weekly, maybe 2 weeks out, to just sort of generate an income and continue to lower the cost basis on the stocks you've been holding for a long time. Or maybe you have a large number of shares through part of work or an inheritance or something along those lines, and you're just selling calls against them. Well, in that case, it's a little dangerous, isn't it? Meaning that, let's say my cost basis on my stock is 25, but the stock's currently at 38, and I'm selling a 40 call. And this week, in the last 3 days, the stock went up to $40.85. Well, see, if you're in a cash account and you want to avoid the tax consequences, you're probably focusing on this a little bit more attentively, meaning that you probably would have rolled it as soon as it got near 40 if you didn't want to be assigned, especially if it had an ex-dividend date coming up and you're worried about the stock being called away from you because of perhaps tax consequences or something along those lines, you know? So that's what you would consider as well. And with a cash secured naked put, of course, you're usually selling a put that's out of the money. You should only be selling puts, in my opinion. You should only be selling naked puts on stocks that you would not mind owning for the long term. If you're selling naked puts and you really don't want to be assigned because you don't want to deal with owning the stock or converting it to a covered call, then as a general rule, I treat this exactly like a spread position. Meaning that if the stock dropped to within 1 or maybe 1.5% of my short put strike price, I'd look to manage the position. What does that mean? Well, I might buy to close it and roll down a strike. I might just buy to close it and look for a new position. That's a potential as well. So what I mean by that is if, let's say, our stock was trading at 54 and we maybe sold the 50 strike put for maybe, well, the price is irrelevant if you're using this method, but let's say I sold it for 65 cents, okay? So it's about a 1% yield, 1.1% yield. If my stock drops during the course of the trade to $50.50 or maybe $50.75, okay, that price range, that's the one, right? So this is, I'm sorry, this is 1% within my short put strike price of 50, and this is 1.5% within my short put strike price. That's when I may look to buy to close the put, roll it down to a 47.5 or a lower strike further out in time, or maybe just get out of the position and look for another one as well. So that's how that would relate to the, in my opinion, the covered call and the naked put. It depends on your trading plan and what your goals are. If I'm in a covered call and I want to be assigned, even if it goes up 8, 9, 10%, rather than put more money in to roll up the call only to have the stock fall backwards against me, maybe I'll just leave it open, get assigned, get the return I wanted to, and then go out of that position as well. Okay, you know, and if the stock falls on the covered call, then you got to be careful. Usually, if it goes below the strike price, especially if you wrote an in the money covered call, where the stock was at 50, you sold a 47.5 call hoping to get assigned, and now the stock drops to, you know, 47.75 or something. So we're holding a 47.5 covered call position when the stock was at 50, but now the stock's trading right at our short call strike price. I may consider buying that back and rolling down to the 45, because my hope was that I would be assigned. I don't maybe want to take the chance that it stays out of the money at expiration. I might. Depends on what premium I received and what my buyback cost is also. So that's a general rule of thumb there for the covered call. A lot of times you won't be able to catch it with the cash secured naked puts and covered calls, which is one of the reasons why I don't trade them. So that same example, the stock was trading around 50, maybe $49. We sold the in the money 47.5 strike hoping to get assigned, and let's say over this 3-day weekend we wake up on Monday and the stock's fallen down to $41 per share. Well, I probably got about $3 for this call, so lowered my cost basis to 47, but now I've got a $6 loss on a now $41 stock. Okay, a sudden gap in price, no contingent order, no you know, stop order is going to help you with that. It's just going to be trading at $41. If you had a stop order, you just get closed out and you get the maximum loss there of $6 or so. Okay, so that's one of the reasons why I don't trade just straight cash secured naked puts or covered calls anymore, is because of that risk, and because it happens more often than we think it does. And you know, that kind of drop, if it drops $6, stock's now at 41. I can't sell the 40 call because I'd probably get assigned at a loss. I'm probably only getting 30 or 40 cents now, maybe 40 cents at best, for the 42.5 call. So what is that going to take me? Well, collecting 40 cents means essentially that I'm going to be in this position for a minimum of probably about 15 months just to get back to break even. If I have to use the out of the money call, it's only 40 cents. To get back that $6 that the stock just declined, you know, from 41 to 47, including the first premium I received, that's 15 months there. So that's a long time frame to try to just make back a 6-point loss. All right. Okay, and I think we touched on this. Andy came back in and he said, do you have a rule of thumb about closing at a % max profit? So many times when I try to hold the expiration date, the stock goes against me, reducing my profit. Yes, and I already mentioned, okay, let's take this 2 ways. Number one, Andy, am I going against my personal rule on that with Texas Instruments right now? Yes and no. Meaning that the max return, remember, that we saw was going to be, for the real position, was going to be around 2.4, 2.3%. I'm sorry, 2.7%, and I could get out at 2.3%, which represents 89% of what the max return I could expect to make on June expiration, June 10th. Okay, but remember, I said my target for this Texas Instruments trade is more along the lines of a 3.5 or 3.8% gain, which I still feel I can get. Even if the stock goes up, if the stock stays between 58 to 62, with 2 more right cycles in, I have a feeling I'm going to be able to get closer to that 3.5% that I want. So maybe selling the June 24th option and then selling a July option, or maybe just going straight to July expiration, but I could have as many as 4 right cycles between now and when my put expires to generate that extra 1% I'm looking for, and I think that's very possible. So even though the Texas Instruments position is at almost 89% of my expected profit for June 10th expiration, my target is actually 3.5, not 2.4, so I'm continuing to roll it. But as a general rule, especially with a bull put credit spread, bear call credit spread, maybe even a calendar spread, a diagonal calendar call or calendar put, if I was in a cash secured naked put or a covered call, maybe even a standard collar position that we were talking about a little while ago, if I'm at, I apologize, if I see that I'm at 80% of my expected profit on the position, I will likely close the position. Actually, it's probably more like 77%. I will likely close the position, take the money off the table, and look for a new position. When are the times that I don't do that? If it just so happens that the stock does start going direction I need it to, let's say I'm in a bull put credit spread, and the stock's been sort of wavering about, and I'm at a 40% gain or 50% gain, I'm still out of the money, and I've got 1 week to go to expiration, then that Monday and Tuesday, the stock moves up maybe 2.5%, and then on Wednesday I see that I could close it right now for 75 or 77% of what I expected to make. Well, I'm likely going to leave that position open for 2 days. It is taking a big chance, but remember, that's because I'd been in the trade for maybe 14 or 15 days, and it hadn't threatened my short put at all. I hadn't seen any decline at all. It'd been neutral. It's just recently moved up. So maybe I hold that there to try to get the full 100% rather than take it off the table. If the stock's been fluctuating in price during that time, and it didn't hit my trigger, but I saw it moving more up and more down during that time I was in that trade, and now I have 5 days left to expiration, and I'm at 77 or 80% profit, I'm definitely closing the position. Okay. All right, now here comes the tough question. Sam asks, what about a long put? Well, that's something I can't answer, okay? What I'm answering here, I'm going to give you an answer, Sam. You know better than that. That's not what I meant. But it's really hard for me to answer a question on a long put, what's the target for long put or long call? It's hard for me to answer because every investor has their own targets for those positions. When we talk about cash secured naked puts, when we talk about bull put credit spreads, where if you're opening a bull put credit spread or even a bear call, we're making maybe 50 cents against a 5-point spread, which is an 11% yield, 11.1% yield, but you open this with an 80% probability, what you're also looking at is a 9-to-1 risk-reward ratio. Okay, so the rules I'm giving for something when you've sold the position, if you've made 80% of what you expected to make, if the stock reaches within 1 or 1.5% of your short put or short call strike price, you might look to manage it. We're saying that because we want to see people avoid this. If I take the max loss, if I hold it open and I take the max loss on a bull put credit spread, if this is a spread that started with an 80% probability or higher, I'm probably looking at this 9-to-1 risk-reward ratio. If I take the full loss, I've just wiped out 9 previous trades. Okay, that's not a recipe for success long term, and it does happen, even to me. Something unexpected like we just talked about happens. I had a successful bull put credit spread that was at 50%, 60% profitability with 5 days to go. I hold it over the weekend. Come Monday morning, the stock drops down, or ETF even drops down 10 or 15%, and now I'm at full loss with 5 days to go. Nothing I can do about it. Well, there's management I can do, but really there's nothing I can do. So, okay, so when you're selling a position, it's to avoid the risk of this maximum loss. In a covered call, it can be worse, right? Not necessarily a 9-to-1 risk-reward ratio, but if you're selling weekly calls or even 2-week out calls and you're averaging 1% return, and you're even getting assigned at a fair percentage of 75, 80% of the time, you have that one stock that just unexpectedly, not due to earnings, not due to anything else, but a pending patent lawsuit comes out, or there's a rumor of a boardroom scandal or shakeup of the boardroom, and Monday morning the stock gaps down 33%. Well, if you had a stop order in place, you get filled for the worst possible price. You take a 33% loss. If you're making 1% or so on your weekly positions, or maybe less, but let's say 2-week out positions, you're averaging 1.5%, you might have just wiped out 33 successful covered call trades. Okay, and the same thing, of course, happens with the cash secured naked put. Sure, you went out of the money, you went 10% out of the money, but now suddenly the stock falls 33% overnight, over the weekend, some unexpected event, you get put the stock, you've got an unrealized 23% loss in your stock, and if you're 10% out of the money, naked puts 1 month out were only yielding 0.7 or 0.8%, again, you just came close to wiping out about 30 trades. Okay, 30 successfully profitable trades. That's the nature of investing. That's why I'm saying that that's why we focus on it. Now, don't want to say yada, 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 but yada, yada, yada. Mike, where are you going with all this? With a long call or a long put, we know the situation, okay? You have an unlimited upside profit potential, similar to what I have with a married put position, and on the long put, it would be the opposite. The allure of it, of course, is paying a small amount of premium. Rather than buy my stock at $50 per share and do a covered call or a married put, I can buy a 50 strike, maybe 3 or 4 month out call for, let's say, $4. If I buy one contract, that costs me $400 to buy the call, and of course, that's the most I can lose. The stock falls, call goes to zero, that's all I can lose. Okay? So, what are the trigger points here? Well, many of you have traded stock, I know, and many of you are probably doing covered calls, and you're probably following that Bill O'Neill Investors Business Daily and some other recommendations that you're setting stop losses on your stock or on your covered call positions somewhere maybe between the 6 to 8% range. 7% is close to the range. We do that with a married put technique, but we're guaranteed to never lose more than 6 or 7 or 5%. Okay? Now, you've got your stop losses set, and you say, okay, now I want to venture into long calls because I can put up less capital. Can I put a 7% stop loss on a long call? No. When I get into the position, it might have had a bid of 390 and an ask of 410. Okay, so I put in my order at midpoint, and we bought our 50 strike long call at $4. That's great. But my broker looks at the worst case scenario if I went to close the position at the bid price. So he sees I paid $4 for this option. I could close it now for $3.90. Okay, and so that essentially means that I'm going to be losing just 10 cents or so off of an investment of $4. Now, this might not be near that 7%, but if there's a day the market pulls back and the bid drops down to 370 or 360, okay, 30 cents now off of $4, that loss is triggered. What I'm saying here is that if you set the stop loss on your long calls the same as you do on long stocks at that 6, 7, 8% range, you're probably going to get called out of stopped out, of every long call 1 or 2 days after you open the trade. All right? So now we've got to play a little numbers game. And in general, most investors I talk to, we're looking at a 50 strike here for $4. Most investors that I talk to set their downside loss on the long call at closer to 50 or 40%. Some might even go as high as 60. Now that sounds ridiculous. You'd say, well, again, why would I enter a position where I'm willing to give up 50% of what I paid? It's because if you set it any tighter than that, at 30% or 20%, one down market day for your long call, you'd be stopped out of the position, right? Because it reacts faster and it's leveraged. So what about the upside? Well, Sam, this is what I can't answer. I have investors that look for a minimum 100% target. Okay, so they're going to close the position when it goes to $8. Is that possible? Sure. The stock quickly goes up to 56 or 57. Their 50 call might be worth $8. They can sell to close it. Okay. If you only paid 40 cents because you were buying a weekly option that's out of the money and the stock moves up 1.5 points and you can close for 80, there's your 100%. But a lot of people I know who are trading these cheap options that are shorter in time are actually looking for a 200% gain. They want to see this go up to $1.20. Are they going to get it? I don't know. And then there's something that's called, I'm not going to call it that, but there's something called the ladder. There's like a laddering adjustment. I don't have a name for it, but I hear investors talk about this. Some of my PowerOptions customers follow this. So I open my call, and it's 3 months out, and it cost me $4. Okay, so we got 3 months of time in this position. And they have this sort of ladder setup rule system where if they make 10% in 5 days, they might consider closing the position. sort of handicap. Oh, I'm sorry, it's 100% in 5 days they're going to close the position. Okay, I'm sorry, that's backwards. Let me get that right. 100% in 5 days or more they'll close the position. Now it starts to scale down and scale up. If they've been in the position for 15 days, they might lower this down. If any time during that time frame now, between 5 and 15, if they hit 75%, they might get out because it's not doing what they wanted. At 30 days, they're still looking for a profit of around 65 or 70%. If that happens, now that they've been in it for 30 or 40 days, they're not seeing the profit that they want, so maybe they're going to get out at 50% if they've been in it for 50 days. Remember, because we had 90 days to go. And if we're at 60 days, if we have over 20% profit, we'll close it. So they kind of do it that way. They're hoping to get this 100 to maybe 75% or more, be surprised maybe get 200% within the first 15 days. But if it doesn't and they stay in the position, they've got these other rules so that, hey, I'm not going to be worried about trying to get 100%. If I've been in it for 60 days, 2/3 the time of the trade I had, and I can get out with a 20% profit, maybe I'll take that. I don't really follow that, but that's kind of a rule because they want to get some profit. They don't want to be left out in the area, okay? All right. Yeah, and then Sam, you're talking about something else too, is that's just for a long call or a long put. That has to depend on what your goals are and what the likelihood is of you getting 100%. And you're going back to the straddle that you have on Apple with the 90 strike price, and the put is almost in pennies. You've got 5 weeks left on the position, but the 90 strike put is almost worthless now because Apple's been going on a good move. So you're selling puts at 95 to get some premium back. Yeah, selling calls against a long call, long put is a management technique as well. We discussed that in our Managing Your Long Options webinar. But you just have to be careful, of course, as you know, and you've graphed it, but you have to be careful what strike you sell because you could seriously cap your gains or you might lock yourself into a loss if you sell it at too low of a strike and too low of a price. Now, we've spent a lot of time today talking about rolling covered calls, maybe rolling naked puts, rolling collar spreads. What are the trigger points? Just want to remind everyone, of course, that at any time you can access our webinars page. And the webinars page is completely free. You don't need to be logged in to access it. Okay? And when you go to the webinars page here, you've got the Power Options Tools section, the Options Strategy section, and so forth. In the Options Strategy section, you'll see webinars here on managing your long call positions, your long options positions. There's some tips there. Here's a webinar on managing your naked puts, talking about trigger points you might use when selling a naked put, applies maybe to an in-the-money covered call as well. And then what rolling opportunities, what types of adjustments might you look for, rolling opportunities, what you can do to turn a loser into a winner, and so forth. And then there's presentations here on managing your spread positions and managing your bull put credit spreads in addition to your other vertical spreads as well. So there's some more information there on what to do with the management techniques. And a lot of those webinars you discuss, especially the long options one, we do discuss more about the trigger points of what to do when you have a profit. What profit are you looking for? What kind of targets are you looking for? What should you do when your targets are not achieved? And what to do, of course, if the stock moves against you and your long call, your long put is looking at a significant loss as well. Excuse me. Okay. So I think it's about it. It's 5:38 p.m. Eastern Time. If anyone has any last-minute questions, I encourage you to go ahead and send those in. Just wanted to, of course, remind everyone that we are on a shortened week next week, a shortened trading week next week. It doesn't matter, though. Kurt is still going to do a presentation Tuesday at 12 noon for the married put techniques. You can see that at radioactivetrading.com. You can register for the webinar at radioactivetrading.com. Wednesday, we're actually not doing the portfolio webinar. That was from last week. We're going to be doing a different webinar Wednesday at 12 noon. And then, of course, we'll be back here Friday at 4:30 p.m. Eastern Time as well. Let's see here. Oh, okay. Here's a specific question. Andy, let me go back to my screen there and clear this up a little bit. So this is hopefully the right screen. Sorry, yeah, okay, I'm on the webinars page there. Let's go back up to the top. All right. So you can see here, hopefully it stays. You can see here the same thing on mine. Andy says, I'm on a trial account right now, and I see a thing here where I can get a free month. The top right of your page shows a free month. When I sign on, all I see is free 2 weeks. Okay. this click here to get a free month, what that is, Andy, is for the referral. If you refer a friend to Power Options and they end up subscribing, we'll give you a month free of service. Okay, so that's the referral program. It's not sign up for a 30-day free trial. The free trial is for 14 days, just as this is set up. But that's for the referral program. If you refer a friend to Power Options, they do end up subscribing, we will give you a free month of service for referring your friend. And of course, the subscription information here, you see we have the different, the end of day service is only $40 per month. It gives you access to most of the tools, but you just have the end of day quotes, and that's $40 per month. The 20-minute delayed service, again, gives you access to all the tools. You just don't have real-time data or the API, and that's $60 per month. And then, of course, the real-time service is $120 per month, and then the premium service, which gives you access to the API, all the back testing, real-time data, and all of the tools, is now $160 per month as well for the different subscription services. But yes, that free month there, Andy, that is based on their referral program, not for a 30-day trial. We do offer 30-day free trials as promotions with some of the other products, such as the Blueprint and things of that nature. But yeah, the standard trial is 14 days as well. All right, well, ladies and gentlemen, I did not see any questions come in after Andy's comment. So I want to thank you for joining me today. I hope you all got some useful education. Remember, if you do think of a question later on, at any time, just send me an email to support@powerop.com. Remember, you can also call us during market hours at 302-992-7971. And the Power Option Trial and subscribers, you can schedule a coaching session at any time. Just click on the coaching session there and schedule a time to talk with one of our experts, me or Ernie or Greg. And of course, as I mentioned, that's a 35 to 45-minute phone conversation as well. All right, everyone, have a fantastic evening. Thank you for bringing me your questions. Have a fantastic holiday weekend. We'll see you back trading online, of course, on Tuesday after the May 31st there, once we get back through the holiday weekend there. So everyone have a great extended weekend. Be safe. Have fun. We'll see you soon. Good night.